You know, when you first listen to experienced traders talk, it can be, well, pretty intimidating. All the jargon, the complex charts, it really can feel like they're speaking a totally different language. So how do we crack this code? Well, think about it. The best way to learn any new language isn't just memorizing vocabulary words, it's about seeing them used in a real, live conversation. And that's exactly what we're going to do right now. We're going to dive into a real-life scenario where a group of traders saw a market in absolute freefall. I mean, all the signs were screaming at them to bet against it. But their final decision? It was something else entirely. And by figuring out why they made that surprising choice, we're going to unlock the core language of trading together. Okay, so at its absolute core, trading is really just about making a bet on which way the price is going to move, up or down. Simple, right? This leads to the two most fundamental positions you can possibly take. First, there's going long. Now, this is what most people think of when they hear investing. You buy something, a stock, whatever, hoping its price goes up. Easy. Buy low, sell high. But what if you think the price is about to fall? That's where going short comes in. And it's a cool concept. Imagine you borrow an asset from your broker and sell it immediately at today's high price. Then, if the price drops like you predicted, you buy it back for cheap, return the asset you borrowed, and you get to pocket the difference. It's a way to actually make money when the market is going down. All right, let's get back to our puzzle. In this specific scenario, the traders saw that the collective mood of the market, what we call sentiment, was just overwhelmingly pessimistic. I mean, everyone was bearish. They all felt the price was headed straight down. So, the move seems obvious, right? If the entire market is pessimistic and thinks things are going down, you should just go short and ride that wave all the way to the bank. It's the logical play. Or is it? To really get why these traders made such a surprising decision, we need to look at the powerful tools they have at their disposal. And these are tools that add both incredible potential and immense risk to every single trade. The first tool is called leverage, and honestly, it's like a financial superpower. It lets you borrow capital to control a massive position with just a tiny amount of your own money. A small price move in your favor can mean absolutely huge profits. But, and this is a huge but, it's a double-edged sword. It's like playing with fire. A tiny move against you can instantly wipe out your entire investment. Gone. And look, this is not some theoretical danger. This quote, this comes straight from the experienced traders in our source material. They're flat out admitting, hey, we've been there, we got liquidated too. It's a painful but absolutely essential lesson that leverage is just incredibly dangerous if you don't respect it. So because leverage is so risky, you absolutely, positively cannot use it without its essential partner, the stop loss. Think of a stop loss as your financial eject button. It's a preset automatic order that closes your trade if the price hits a specific point. It takes all the emotion out of the decision and cuts your losses before they get completely out of hand. And this is exactly why it's so critical. This quote, it just perfectly captures that gut-wrenching pain a stop loss is designed to prevent. It's all about having the discipline to accept a small, planned loss so you can avoid a catastrophic, account-destroying one. So the crucial point here is that these two things, leverage and stop losses, they aren't separate optional tools. They're a single, unified system. They go together. The power you get from leverage demands the protection and discipline of a stop loss, period. There is just no other responsible way to do it. Okay, now that we understand the tools of the trade, let's get back to our puzzle. Why didn't these expert traders just short the market when everyone was so bearish? Well, let's start uncovering the hidden clues they saw that warned them away from what seemed like the obvious move. The very first clue was something called a support level. Now, you can basically think of this as a price floor. It's a point where, historically, buyers tend to rush in and stop the price from falling any lower. So trying to short an asset right above a strong support level, it's kind of like punching a brick wall. You're probably just going to hurt yourself. And they didn't just have a vague idea of this floor. They had a very specific number in mind. The traders identified what they called a relatively strong weekly support level right here at 98,600. Now think about what that means. It means even if they did short the market, and were right, their potential profit was super small before the price slammed into this massive wall of buyers. The risk just wasn't worth the potential reward. The second clue was a little more complex. See, even though the market sentiment was bearish, driven by data like negative funding rates, it was also incredibly fragile. It could be shattered in a single instant by one piece of unexpected news. As the traders themselves pointed out, what if some major geopolitical event happened out of the blue? That could change everything in a heartbeat. So let's put all the puzzle pieces together. On one hand, you have an extremely bearish mood telling you to sell, sell, sell. But on the other hand, you have this powerful price floor right below you, seriously limiting your potential profit. And then, floating over all of it, you have the total wild card of unpredictable global news. So, what does a professional trader do in that situation? And here it is. This brilliantly illustrates the solution to our puzzle. This was their strategy. Look bearish, don't short. They saw and acknowledged all the signs that the price should go down, but they chose not to act on it. Why? Because the signals were just too conflicting, and the risk of getting caught in a sudden, sharp reversal was simply too high. So they decided to wait. So, just by working through this one puzzle, we've started to decode the core language of trading. We learned that there are two basic directions, going long and going short. We saw how the incredible power of leverage absolutely must be balanced with the essential protection of a stop loss. And, maybe most importantly, we learned that reading all the market signals, the support levels, the sentiment, gives you that crucial context, which sometimes shows you that the smartest, most professional move you can make is no move at all. And that right there really is the ultimate lesson. Professional trading isn't about constant, high-octane action and wild gambles. It's a waiting game. It's about patience, discipline, and waiting for that perfect moment when the odds are finally, clearly stacked in your favor. Which leaves us with one last thought, one that goes way beyond the world of trading. In a world that is constantly demanding that we take action, react faster, and always be doing something, maybe the most powerful move, the greatest strategic advantage we can have, is simply the discipline and the wisdom to do nothing at all.